Tuesday, the 25th of July, 1 p.m. on the East Coast. Guy here, Dan's there. Very svelte Dan, I might add. He had glasses on, but apparently glasses moire into something. I don't really even understand what moire means. By the way, this is the last Tuesday in July, which means tomorrow's the last Wednesday in July. I can continue going down that road, but I think you understand what I'm saying. This is Market Call, Dan. Today's Market Call brought to you by CME Group, where risk meets opportunity. You know, we got to get Laird Hamilton on this show at some point because he's just a badass and he does that.
You would join us on this program? And why are you thinking about Laird Hamilton in this moment?
Isn't he the cat that he's the surfer dude, right?
He is the surfer dude.
And he does the CME commercials. So, like, if you watch those commercials on the TV, he's a guy, like, he's standing on the beach and he's looking over to the waves and all the numbers are going through his mind. And he's basically trying to figure out where the risk of the wave meets the opportunity of the ride. See what I did there?
Well, some people over at CME. You could probably get Terry or Anita or Colleen on the blower here. Maybe we could set that up, guy.
I'm in for that. And by the way, obviously, FactSet provides our charts and what have you. They're our data provider, Dan. Financial data and analytics powered by Tomorrow. Now, before we get started on this Tuesday, if I'm Saquon Barkley, which I'm not, the guy's a freak. I mean, you see pictures of him. He is a specimen. But I would call my agent or my legal staff and I say, you know what? You're summarily fired because they really led him down the improper path. He did sign with the Giants a one-year deal, a $2 million signing bonus. Good for Saquon. He'll be playing for another contract next year. But listen, as you know, Dan, they can probably tag him again next year. So the life of an NFL running back, not dissimilar to the life of somebody that's been fighting a very bullish tape. That would be yours truly.
That is a fact. It's interesting. We had a lot of great feedback from our On the Tape podcast. We had Mike Wilson on Friday and I guess on Monday in his note. I mean, he said clearly we have been wrong about his call for the first half of this year. He was very right for the back half of 2021 and all of 2022 being bearish. He made a couple tactical bullish calls. But, the other thing is, I think it's important to remember is that he also, in the throes of the pandemic, when the S&P was down 35%, he also made a big bullish call there too. So it's just kind of interesting, kind of the sort of back and forth. And I'm just bringing that up right now, Guy, because you said you've been fighting this market. I've been fighting this market. We're coming on kind of 6.5 months or so, or, nearly 7 months of fighting a little bit here. It's really hard to look at a lot of the charts, Guy, like no matter what you're looking at and not say that things like if we could take all the stuff that we think we know about economics, not being economists, all the things that we think we know about, like prior recession signals, prior like economic events that might lead to bear markets and risk assets. Throw all that out there. Just do what Carter Braxton Worth does and look at the pictures, and you could paint a rosier picture than you and I are kind of leaning into at the moment.
Yeah, without question. I mean, and we talk about it all the time. You actually were talking about the NASDAQ months ago, how the chart looked fantastic, and subsequently the S&P has followed. S&P broke that August high from last year, traded higher for a couple days, did the back and fill back to that then support level, and we've been off to the races ever since. And here we are into a pretty interesting series of earnings over the next couple of weeks, specifically, obviously today. And you're right. I mean, the charts look great. Problem is, as good as the charts look, that's how shitty I think some of the fundamentals are out there as well. And that's sort of the push and the pull of this entire thing. At some point, somebody's going to emerge victorious. And I would submit that all the things that you learned in school, I learned in school, that we've been through in terms of the markets, they're going to come home to roost at a certain point, and we might be on the precipice of something. And if we can pull probably our first slide, we can talk about how it always looks great until it doesn't. And that's not meant to be glib, but things typically, everything looks fine until things change. And when they change extraordinarily quickly.
Yeah, so this is a good one here. So this is our boy Cantro. He's got a nice following there on the Twitter. He's also, he's been on our podcast before. We think very highly of Mike here, and I think that this tweet is kind of an interesting one. Or it's called a Zeet now, or Zeet or something like
It's
that.
Twitter. It's a tweet.
No, they're changing it, dude. It's going to be a Zeet.
I mean, let me ask you a question.
Yeah.
When who's that cat? Zuckerberg, he changed the name of his company, right?
Meta.
I
Yeah.
don't, but have you heard me utter that name? No. I mean, what did they change years ago? The Google they changed too, right?
To the alphabet, but it's different. I mean, like literally, I think Elon wants to erase all existence of the word Twitter, which I think is kind of interesting. But let's look at this tweet from Cantro. And so, recession surprise investors every time. It always looks like a soft landing until it doesn't, and then when the minds are changed, too soon to declare it's different this time. And so many have done so before. Behavioral patterns repeat across history. And I think it's interesting to go back and look at 2007 in October, September of 2000, and then obviously all the way back to March 1990. And you see what Cantro's throwing down here. I guess there's probably other instances where some of this data looked the same, but we didn't end up having a recession. So that doesn't make the tweet here, Guy. Thoughts here, because we this is also something we spent a lot of time in our podcast with Mike Wilson talking about, like how we could be wrong, how he could be wrong about S&P earnings. You know, part of the theme that he's talked about is that, you know, like we've seen S&P earnings hold up because we've seen companies kind of slightly lower the bar than meet that lowered estimates, right? And so, yeah, we've still seen a flattening out of earnings, but we haven't seen an all-out decline, which many at the end of last year, when the S&P was trading south of 4,000, it got, what is 3650 or something like that, maybe a little lower, Guy. You know, a lot of folks were thinking that in the first half of this year, we'd be in a recession, and the Fed would be going from, you know, raising rates as aggressively as it had to possibly cutting rates.
Right. And what's amazing about that is the fact that they're still on this higher for longer and the market hasn't blinked an eye. I mean, that to me would have been the worst of the two outcomes for the market. Yet it seems, well, it's not, I can't say it's a better outcome. You can't do the counterfactual. But with that said, you know, the market seemingly shrugging all these things off. And Doug Cass seems to be in our head because he's been texting me. He might be texting you. And he's been talking about some of the things that we've been bringing up as well. There's sort of this reacceleration in energy prices. And again, that UPS Teamster deal, I mean, that is inflationary. And that's something I think we talked about on Fast Money. But if you think about it, it speaks to wage inflation and the fact that you got to pay people more. And that's out there as well, which makes the Fed's job that much more difficult, which is why I think when you hear from them, I don't know how the market's going to interpret it, but they're going to be hawkish because A, they have to be, and B, because the market suggests they have enough flexibility and enough wiggle room and enough rope where they can be.
Yeah, you know what's interesting about that, and I think that's a theme that we're going to hear a lot about. It's like right now, I think some of the narratives out there is that we're doing really bad as a country with illegal immigration, and we're also doing really badly with legal immigration, right? So, and one of the things that we need to kind of help this, like the Fed situation as it relates to wages and 70-year low unemployment, I guess we need more legal immigration, because there was a report out this morning, and I think it was in Bloomberg, it was talking about the chip industry and all the onshoring and all the incentives that exist, right, with this CHIPS Act and the IRA and all this sort of stuff. Part of it is kind of manufacturing chips here in the US, creating fabs. We keep seeing this kind of pushed out. But the report that I read this morning is that by 2030, we're going to need like 115,000 really skilled workers to work in these fabs and make these chips. And if you're just looking at immigration levels, if you're looking at graduation levels from, you know, like engineering schools and the like here, we're going to come up short by maybe half of that. And I just think that's really interesting. So what does that do? That puts out greater demand for wages for good workers. And if we do have that sort of inflation embed itself in the economy after we've become really used to cheap labor for 50 years, which has kept down consumer prices, right, for a very long time. I mean, that is really a conundrum that the Fed is not going to be able to fix, whether they go 25 basis points, you know, tomorrow or not, right? Like we might find ourselves in a much higher for longer environment because of the way some of these things are working against themselves, and maybe they are different this time.
I agree with that, and that speaks to a, you know, I'm reading the comments as we're talking, and Gary made a comment. I'm sure it was meant to be derogatory, but he said something to the effect that, you know, if the strike continued, or if there was a strike, I would be saying it's inflationary because it's disrupting supply chains. And yeah, maybe I would have said that. I don't know. I mean, that's one of those situations, though. Either outcome, you can make an argument would be inflationary. And I'm not just pulling stuff out to sort of defend our narrative. I mean, that's what's out there right now. And to your point, they being the Federal Reserve, I think they understand the predicament that they find themselves in. The rhetoric around it and people talking about soft landings and threading needles and all the bullshit that you hear. I mean, I don't necessarily think they've bought into it because, quite frankly, if they have, I don't think they'd be as hawkish as they are. So we'll see.
Yeah.
And again, you should listen to that podcast with Mike on Friday that dropped. He talked about, in terms of history, we're right there at what should be the beginning of the lag effect kicking in. I thought it would take place sooner. It didn't. But here we are, effectively, 18 or so months down the road from when this entire rate hike cycle started. And again, Doug mentioned it. I'll mention it again because I think it's important. 9.1% CPI in June of last year. Now we're sort of on the other side of things where it's going to be more difficult for that trajectory lower to continue. And I would submit, and I think the data's probably going to back it up, you're going to start to see a reacceleration of inflation over the next few months. And that's going to catch people off guard. And we're going to do a trade, I believe, or we're going to take a look at gasoline and some of the stocks around it. I mean, very quietly, Dan, gasoline's going to a 52-week high. So there you go.
Yeah, no doubt. Let's look at the S&P futures here, the E-minis here, Guy, because I think this is kind of interesting. We're getting into the kind of meat of mega cap earnings here. And when we talk about just kind of, levels here, you see this kind of runaway breakout. I mean, where were we got to like kind of 4,100 and at some point in kind of mid-June. And it looked like, we're just kind of stuck in that consolidation above those kind of highs from early February or so. And there you go. It's just like a launch pad. It's 4,100 to 4,600 here. And you look at that breakout level from last August, that was what, 4,350 or so. I mean, listen, man, until we go back and put a little fear in this market, I just really have a hard time thinking about how the market can go that much higher. We know the all-time high was in and around 4,800 in the first week of January of 2022. And you look at that 200-day moving average, it's kind of picking itself up a little bit here. It's almost up to that 4,100 level. I really feel like a lot of the, a lot of the debate, about, just valuations as it relates to the market, what's priced in, how much of this AI hype has worked itself into all over the market, I think would come out if we saw an S&P, headed back towards its 200-day moving average. A little fear would be something that I think would be, kind of welcomed by bulls, especially if you're looking for a reacceleration of some of the themes that have gotten things going. And, the other part is, it's like, listen, there's a lot of stocks that are joining the party right now. We talked about some of these regional banks. We talked about the major money center banks, how they've acted since their earnings, even like a Bank of America, which is, flat on the year. It's had this huge run, breaking out of his own. So there's lots of things that transports. You've seen that. Your home builders guys got back on their horse a little bit. And this is with a 10-year at 3.9 or so.
Listen, there's clearly a money flow situation as well. I mean, I think people that now think we're on sort of terra firma in terms of the economy are finding stocks that they deem to be value and they're throwing money at them. And I think that's why you've seen some of the moves you've seen. So on valuation, they're probably justified. Again, in terms of these banks, these regional banks, I'll say it again, in the absence of bad news, they're just going to levitate. And that's exactly what's happened. And I'm not just saying this today. I mean, this has been something we've probably been saying since late April, early May, and that's played out okay. I don't believe it. Doesn't matter. I mean, you make money whether you believe it or not if things you own go up. So I think there's something else to happen in the regional banks. Sheila Bair was on Fast Money last week. She said pretty much the same thing. And I think to a certain extent, the consumers might be at sort of the intersection of all of this, because I do think you're going to get to a point where they're going to start to be challenged. And it's going to manifest itself, I think, in lower earnings for regional banks and some of these regional banks going by the wayside. In terms of the S&P here, I think you're right to point out, each passing day that we go higher, I think it just makes that inevitable move down to the moving average that much more violent. So even if the most ardent bulls, I think you want to see at some point just a reasonable pullback to sort of flush the system a bit, Dan.
Yeah, and I'll just say, I'm looking at my fact set screen here, guys. I see a lot of green. So we saw some of the big tech names sell off, since the earnings last week from Tesla and Netflix. And we saw money flow into like some of the sectors that we just talked about. But on a day like today, and this is post GM's earnings, it's down 4%. And, looking at what the airlines and some of the results that we had and looking the way that they are acting today. When you just mentioned the consumer, that's kind of why I thought about it. I mean, we went from some really weird dynamics post-pandemic in the auto sector and the airline sector, whatever, and it seems like that's kind of coming undone a little bit here. So I think that's really interesting to keep an eye on those. One day does not make a trend by any means. Another name that you talked about, and we were talking about consumer discretion. I think Tim on Fast Money brought it up last night. He was talking about his short in Nike. I mean, some of those names kind of feel like they're falling by the wayside a little bit. But then on the flip side of it, look at Cleveland Cliffs up 8% today, FCX up 4%, Alcoa up nearly 7%, Letter X up 3.5%. I mean, there's stocks making 2-day moves here that look really, really powerful, and they do look sort of pro-cyclical. They look pro-growth. You know what I mean? They look like the sort of things that people would buy if you think that the economy is about to inflect a little bit.
And it probably speaks to what we just talked about a few minutes ago, this sort of potential reacceleration of inflation. And that probably is a good segue to this question from Justin Power. Do you think China is in good investment now, considering the trouble ahead here in the U.S. economy? So I look at China through the lens of the FXI. Obviously, their economy is somewhat manufactured to a point and engineered. The FXI is an interesting animal here. It's been sort of going sideways for a while. I think we can speak about the components. I think there's a chance you could get it back to sort of the 33 level. That's where we failed in January. And that's also, if you go back and look, where we failed this time last summer. So that's a reasonable place to get. And listen, a $4 move in the FXI here is probably a 12 or 13% move to the upside. So I think that can be anticipated. The question is how long lasting it's going to be. And if you look, every meaningful rally has been sort of sold off over the last couple of years. And then if you go back and really look, I mean, the FXI effectively has been trading effectively sideways for the last 13 and a half, 14 years. So it's clearly a trading vehicle. I don't necessarily know if it's an investment thesis, though, Dan.
It's interesting when you think about this. It's just amazing how much some of these indices or these ETFs have just been permeated by, like tech stocks and the top holdings, Alibaba, Meta1, Tencent, they're all about 9% each. So that's 27%. They're all, digital companies. JD is about 4.5%. Baidu is about 4.5%. NetEase is about 4.5%. So that's, digital, it's internet, it's gaming and the like here. So, you're getting to a situation where the FXI is basically 40% some of these kind of internet names or gaming names and the like here. So all that's kind of interesting. And then what I think is most interesting about that, it really does feel like a domestic play. It's not like our major tech companies, which get a disproportionate, or not a disproportionate, but maybe 30, 40, in some cases 50% of their sales from outside the US. I mean, these are largely getting their sales from inside the US. Then you have China Construction Bank, and so there's insurance companies, there's industrial companies, there's a bunch of stuff in there. I mean, that's how you play the China trade. But let me just tell you, the data in China, we're trying to pick holes in what looks like, I'm just going to say it, Guy, a lot of people are saying this, a Goldilocks sort of situation here in the US. Over there, it just seems like downright nasty. I mean, it really does seem bad. And so to me, we're talking about keeping rates, normalizing rates somewhere well above they did at the last cycle here. They're talking about continuing to ease.
Yeah, when was the yuan devalue, the meaningful one? I think it was August of 2015. It might have been 16. I'm getting older, so I forget. Yeah. But, I'm not saying, again, we're on the precipice of that, but that's something you have to take into consideration as well as things continue to slow and maybe they start to lose the ability to engineer things. Let's take a look at the NASDAQ real quick, because, again, as I mentioned a few minutes ago, this is something you've said for quite some time. It probably goes back to the spring, that the chart looked great. And this uptrend that's been intact continues to sort of make its move from lower left to the upper right. My concern, the same way my concern is with the S&P, not necessarily that it doesn't look good, but with each passing day, when you get standard deviations away from the moving average, which is historically somewhat mean reverting, it becomes a slippery slope, right? I mean, unless something has changed or unless time suggests the moving average will catch up, and that will take a long time. These things typically happen in a pretty violent way. So as I said earlier about the S&P, I'll say the same thing here. With each passing day that we just sort of levitate, I think it makes the inevitable that much more violent.
Well, listen, a lot of this is obviously going to come down to how these mega cap earnings are tonight. After the close, we have Microsoft and we have Alphabet, and both are implying about a 5% move in either direction. And when you think about Microsoft as a $2.5 trillion market cap company, you do the math on that, that's a $125 billion move they could have in either direction. Alphabet, a little different here. It's at one point, 5 trillion or so. But I think that, just kind of considering the price action we saw after Tesla and Netflix last week, and Netflix is a much smaller company than any of these, and Tesla was, I think, 900 or so billion that sold off 9.5%. I mean, if we were to have Microsoft sell off 5+% or so, and a couple more of those, you're going to have the NASDAQ futures. You're going to have them back testing that uptrend line, and I think that a lot of folks, Guy, might be really interested in reloading, it's just south of 14,000 in the NASDAQ futures here. And it might be a level that you would start to pick at, because if that was the case, then that means some of the froth in and around AI came out of some of the biggest names in the market. And so if the fundamentals on some of these are okay, it's just the valuation has expanded, you'd welcome a 10% back.
That's going to be the trick, right? If in fact we do get a sell-off, and again, I think we both think it's going to happen. We've thought it for a while, just to put it out there. But the trick is going to be, if it starts to happen, there's going to be, for a lot of people, and I might be one of those people, it's hard to say at this point, but there's going to be a want to sort of say, okay, that's the sell-off. Let's just get back on solid footing in terms of our thought process, and then we can go from there. I think that's sort of the knee-jerk reaction, where the right reaction might be, okay, this is starting to finally take hold. Let's see how low this thing can get. So I totally understand what you're saying in terms of looking for a level to reload, but that actually might be the wrong trade if things start to unravel.
Well, and then I would say it really depends on your time horizon. Okay. Like, so for instance, for me, we talk about when we trade futures, using stops all the time, right? But it all depends how you risk manage a position, how you enter a position. Because let's just say let's say the S&P or these NASDAQ futures were back at 14,000, Guy, right? And so let's just say you said, I'm going to start building a position. I'm going to dollar cost average it. I think it's ultimately going to get back to that 200-day moving average, which is maybe down another 1,000 points, right? If you will, from levels where it might make sense to start a quarter of a position, then you would just kind of average into it. If you're thinking about, okay, this is a position that I want to hold for quarters or possibly years, and I want to work myself into it, rather than buying a full position and then putting a really tight stop on it and then moving that stop as you kind of go, further in the direction in which you hope. So to me, I just think that's a really important part of trading. And, all during 2022, when the market was going lower, and you and I, on CNBC, we'd be asked, what's your buy point? What's your buy point? When would you pull your kind of bearish thesis and buy? And what I would say is, listen, if you're not a trader and you're not thinking about two-way action, right? If you're looking about the long term and you do dollar cost average, then all during 2022, if you would dollar cost average in the NASDAQ futures, or the QQQ or the ETF that tracks them, you would have ended up with a pretty good price, after 1 year of a downturn that, reached more than 30% or something like that. So to me, it really depends on your time horizon and whether you view something as a trade and how you basically invest and how you work into a position.
Let's look at the VIX real quick, just to take a gander, because it seems to have found a bit of a home on the downside. And it's, there have been a couple days where it appears to want to sort of peek its head up, only to sort of get knocked down. But here we are. You had obviously that one day move to the upside, maybe a day and a half, but it gave it all back. Again, I'm not suggesting this says anything, and I'm not suggesting you trade it, but I have heard some commentary out there that there's been some people playing for a pretty significant move in the VIX. Maybe we'll be hearing more about that over the next couple of weeks. But again, every time it sort of gets down to these levels, the question you have to ask yourself is, what are we doing here? And for those that sell volatility, am I getting paid enough to do so?
Yeah, no, that's a fact. And I mean, at this point, if you're just selling calls against long positions to take in some premium, you're not really getting a whole heck of a lot for that. Let's talk yields for a second here, Guy. We have the Fed meeting tomorrow. The CME Fed Fund Tracker is pricing a near certainty that they're going to raise 25 basis points. I guess the real question comes down to is kind of what is their outlook for rates? Are they going to stay higher for longer? What do we start pricing as far as cuts in the, some point in 2024? Thoughts on rates here? You've been really focused on this kind of 100 basis point inversion in the 210 spread or so. And just, it's 99.9. You thought when it kind of re-steepened to 45 basis points or so about a month and a half ago that we'd get back to the wides near one. But you and Liz had a great conversation on the tape on Monday, and it's not just kind of, where we are as far as that inversion. It really is. You guys seem focused on the fact is how we get to a re-steepening of this and what that means for the economy and what it might mean for risk assets.
And listen, Elizabeth does this. I mean, in her seat, she's read a lot more. She understands this a lot better than I do. But one of the things she's been saying, not for weeks, but for months, is the inversion was troublesome, and it is. But what troubled her more was the point where we start to re-steepen or steepen at all. And we saw that obviously, a month and a half or 2 months ago, only to find this inversion back to about 1%. Now it's anybody's guess. And again, I'm not trying to sort of look at it through my bearish lens, but I think to be further inverted at this point, to go out to maybe 125 basis points, I don't think that's particularly good. And the point that Liz has been making, if we start to re-steepen, it's probably going to people are going to think it's good, but history suggests it's not. That's when things actually start going pear-shaped. So we're at a really weird level here in terms of the 2s, 10s. And one of the things that I've said for a while is it's hard for me to understand it when clearly the bond market doesn't understand it either. And I say that, again, watching days that we move 8, 10, 15 basis points in either 2-year yields or 10-year yields. I mean, historically, that's something that shouldn't happen, but seemingly happens on a weekly basis now.
Yeah, I love that phrasing of that is like the bond market hasn't figured out what it wants to do either. And if you look at that 10-year chart and you look at the kind of, we have this kind of, narrowing of this range here. We're holding the 200-day moving average. If the 10-year got to 4%, you'd say fine. If it doesn't break out, it might be on its way back to 3.5%. And, what does 3.5% of the 10-year mean for growth and the like? What does it mean for the 210 spread? What is the shorter end doing at that point? So that'll be really interesting to kind of track and see. I mean, to me, I'm most interested to see how the yields react to what the Fed has to say tomorrow. But one thing, and you've been all over this, and I think it was late June. I tried to on this program, press a little bit crude oil. It was trading around 70. I thought we'd have a retest of those kind of mid to low 60s. I put a tight stop on that. It got stopped out at 72. But then when we were thinking about this move here, I mean, Guy, on a 1-year basis, you look at this crude chart. I know you want to talk about gasoline, but we've just broken that downtrend, and that uptrend that's been in place just for, the last kind of month or so. This looks like a pretty powerful setup if it can kind of maybe consolidate here and make a move back towards those highs from a couple months ago, and then maybe
I think the April highs. I think the April high was probably 83 or so in TI. I think we probably take a run at it and suggest through this downtrend line we probably should. We've finally gotten through the 200-day moving average, which is a good thing. And they pressed, shorts pressed, bears pressed for months, unable to break it. Now, again, they've probably lost the battle. Now I think the bulls sort of have the upper hand, and I think it's going to play itself out. It's certainly playing itself out in some of these energy names. If we can take a quick look, Jacob, throw the OIH up real quick. I mean, this was $245, I want to say late May, early June, and I think today we just made a 52-week high. So again, very quietly, you've had this move that nobody seemingly is talking about. And within a couple points now, you're going to start talking about multi-year highs in the OIH. By the way, I still think it goes higher. Gasoline, though, let's pull up a gas chart because, again, Doug Cass has been talking about this. We've been talking about this. You have a 52-week high in gasoline. It doesn't show it right now, but trust me, late last week, we made a 52-week high in gas. With that said, I mean, we're right there. And I think gasoline, it's telling its own story. And by the way, this is gasoline before any of the seasonality of hurricane season comes in. And if you've been paying attention to the weather, and, I'm not talking about climate change, I'm just saying pay attention to what's going on globally. And you would believe that, gas is in for a really interesting late summer, early fall. And that's obviously inflationary. And quickly, if you want to pull up a Valero chart, because I think this obviously is working too. I mean, Valero pushed down to about 104. The crack spreads were not working for VLO when crude was sort of on its ass. But now this is starting to reaccelerate as well. And this is an environment where refiners are really going to start to win. So that's how I look at the energy trade in a nutshell.
Fair enough. So you're thinking higher for gasoline. You've been talking about it on our pods also, Guy, that, a reacceleration in inflation might be the thing that basically causes the consumer to possibly break as the saving rates are going down. Unemployment, I guess, can only go one way at this point here. And again, I think you and I have made this point on many occasions. It's not like we're hoping for unemployment to go up, so we're right about the stock market by any means. I think there are a lot of scenarios because of what we started out talking about, some of the weird immigration dynamics and the holdover from the pandemic and all this sort of stuff. I mean, we are basically don't have enough workers to do a lot of the jobs that this country is going to need to do if we really want to kind of, bifurcate a bit from our reliance on cheap manufacturing in China and the supply chains, which proved to be a very difficult situation in a black swan event, for a national security, standpoint. And then we haven't even really talked about the geopolitical stuff, which we don't really need to, but all those disruptions that in and around, what happened with Russia's invasion of Ukraine, whether it was energy or grains or this or whatever. I mean, that, as I think you've said, could play out in spades if there was anything as it relates to China and chips in Taiwan and the like here.
Look, 100%. In China, Taiwan, I mean, if you want to look at a Twitter account, take a look at Kyle Bass or Google Kyle Bass and go to videos. I think he was just on Squawk Box. Today's Tuesday. He might have been on yesterday talking about some of the things that he watches, and the warning signs are clearly there. I mean, there's obviously a policy of appeasement going on, and that's not just this administration, other than, I guess, the prior one. I mean, that's been the strategy for quite some time, and, it sort of works until it doesn't. And I do think, unfortunately, something is going to rear its ugly head there, and that could be potentially, and I'm choosing this word, catastrophic for a lot of these multinationals if, in fact, China did something in Taiwan. Before we get out of here, the implied move of Microsoft, let's pull up a chart because I think that's obviously what everybody is watching for this afternoon. I know we'll obviously lead fast money with it tonight, but I think there's an implied move of about 5% or so. This trend line is intact. You see where the 200-day moving average is, about 275, which is at this point now $75 lower, which again is quite remarkable. When you get towards, a couple standard deviations away, and you can look at this chart historically, the mean reversion we've seen, you have to ask yourself, how long can this move last?
It's interesting, Guy, and I had a great conversation with Gene Munzer of Deep Water Asset Management yesterday. It dropped in the podcast stores on the tape feed, and Gene and I went through Microsoft and Google's report, Meta, later this week, and then we have Apple and Amazon next week. So take a listen to that if you want to hear what Gene had to say, because we talked about Microsoft and we talked about the pricing of their Copilot, the Office suite of AI tools, which really, I think, a lot of bulls were pretty excited about. The stock rallied 5% in a straight line. That was a week ago. Last Tuesday, we were talking about it on Market Call as it happened. Gave back all those gains, came all the way back, Guy, to 340. If you look at this chart, though, and you look at that 340 as a kind of a breakout level, and you see the fact that we bounced off of it, you see yourself, the stock just kind of caught a little support there, man. You know what I mean? And so, Gene had this really great point, though. It was like, listen, that was the upside that they're able to kind of guide to, if you will, right? And maybe they give some more clarity on it. I doubt that they're going to be able to give that much visibility on what that means in the current quarter. But if it's better than people expect, I mean, maybe 340 is support. But the flip side of it is, if for any reason they miss and any reason they guide down, this stock's going through 340 very, very quickly, and it's probably on its way back to 320. And that could happen like that. So thoughts there, Guy, on how you might be positioned if you're long. Maybe you don't have to just kind of peel out of it. I'm not thinking about initiating new long positions. And it just seems like you might end up having a lot more information tomorrow morning after the call and after you see the initial reaction to the stock. And that might be the place to trade it.
Last quarter, by Microsoft standards, was not great. It suggested slowing growth, with the market seemed to shrug off, but people got jazzed about AI, and then you've seen the subsequent move. So I've said this, and I think I'm right. I think so much of this move, at least since March, April, May, has been all predicated on multiple expansion. People are willing to pay more for a dollar's worth of earnings. And maybe that's going to be justified. Maybe this is a company that can grow into the earnings. But right now, at current price, you have a stock trading north of 31 times next year's numbers. That's just historically expensive for a mature company, regardless of what new industry they're getting in. So, yeah, it's concerning. And you have seen moves to the downside before in Microsoft. And, I think the AI card has probably been played. And this is a quarter where people might be more focused on what appears to be slowing cloud growth. So we'll see. And again, it's not trying to be dogmatic. It's just sort of reading the tea leaves. Here we are, figure it out from there. But that 275 seems like light years away, Dan.
Yeah. So then the other one tonight after the close is Alphabet. That would be the Google 5% or so implied move in either direction. And what's interesting about Alphabet, Guy, is just the relative underperformance, versus some of the larger platform peers, if you will, up 37% on the year. I know that sounds ridiculous. I'm saying the relative underperformance. I think there's lots of folks who thought that Microsoft gains were at the expense of Google and some of the kind of their slow reaction to their open AI collaborations that Microsoft have been able to announce for Bing and for their productivity tools. Well, look at this thing. You see it consolidating in and around that August high here. From a valuation standpoint, I mean, this is a company that trades about 23 times this year, a little less than 20 times next. So far, far cheaper, let's say, than, a Microsoft and an Apple, double-digit expected earnings growth, I think mid to high teens for the next few years, and then high single digits sales growth this year and about 11% next year. So, guy trades cheap-ish, but I think going back to my conversation with Gene Munster, he also sees, while he's very positive on this one, he also sees that the near-term headwinds, right? So maybe it's in cloud, maybe it's in just kind of the perception about where they are with search and what this kind of chat GPT enabled Bing or other services might be a headwind to Google's search business. That's one thing. Listen, if this thing is back below 110, I think it gets bought. I would probably buy it myself as long as there's not any big disasters. And a lot of it has to do with the fact that, Guy, maybe some of these stocks just air comes out of them. If everyone heads for the door at the same time, maybe there doesn't have to be a meaningful guide down. It could be like Tesla, where 3 consecutive weak quarters of gross margins is just enough for people, and they sell first, ask questions later.
Without question, Google's the one we talk about in terms of being reasonable or actually attractive on valuation, and that's been true for quite some time. It was true the entire way down, and it's been true since the move in early March on the way back up. But Google's also been the one that has said some disappointing things a few times over the last couple of years. So they're not immune from, obviously, the whims of the market. So you could see a move down to that 103 level, and that really would make sense. And, that probably continues this uptrend. It probably would find support at an uptrend we've been in since February or so, Dan.
Yeah. Okay. Here's one last thing before we get out of here, Guy, and I want to kind of highlight this. So Spotify is trading down nearly 15% today. It was down 5% yesterday. They announced a price increase yesterday, the day before their earnings, of $1 for like their premium, like streaming service on the music. I mean, look at the sort of move. That stock, heading into its print was up more than 100% off those lows, Guy. It was up 100% on the year. To see the stock go down from 180 to 140 like that over a couple headlines, I think you got to pay attention to this.
Yeah.
And this is not $100 billion market cap.
No, it's about $28 billion market cap. So it's not like it's $1.5 billion company. I mean, that's a significant company. And to your point, when you have moves of this magnitude seemingly coming out of nowhere, because if you looked at this chart 3 days ago, you would have said, my God, this looks lower left, upper right. This is going to continue its trajectory. And it goes back to the original slide that we had with Cantrell. I mean, things look great until they don't. And I'm not suggesting the entire market is predicated on Spotify. That's not what you're saying either. Yep. But you can see things like this happen as you're looking at right now.
Well, yeah, and I just want to bring one other point, because a name that I think could have a big move one way or another is Snap, and they report after the close tonight. And that stock, if you think about it, has a massive implied move, about $2.90 in either direction. That is what the stock market is implying. That's nearly like a 20% move in either direction. The stock, Snap is up 40% on the year right now. It's had a huge run. A lot of those gains are coming just in the last couple of months. And again, this is obviously also a much smaller market cap company than many of its large social peers at about $20 billion market cap. But how this stock reacts, I think, to whatever they have to say on the current quarter in guidance is going to be really important. On a GAAP basis, they're barely profitable here. So, again, Spotify loses money. Maybe we're going to see a bifurcation, Guy, again, to use that word, of companies that make money and are harnessing some of these things, these secular themes that investors are really excited about, right? And ones that can't keep up and can't continue to go higher. Maybe those are the ones that just kind of get baby with the bathwater here. So that, to me, pretty interesting to keep an eye on. Let's see how spot closes, and let's see how Snap reacts to what's likely to be probably not a great quarter in guidance.
Buckle in, people. It's going to be interesting in the next few hours for sure. So we'll be back tomorrow regardless of what happens. I want to thank CME Group, our sponsor, where risk meets opportunity. Obviously, FactSet Financial Data and Analytics, powered by Tomorrow. Tomorrow, Dan, we'll be back with the great Carter Braxton Worth. We'll be breaking shit down left and right.
Yeah, we will. All right. Thanks, Guy. That was a whole heck of a lot of fun. Thanks for all you guys being here. Thanks for the comments. We'll see you tomorrow with Carter.